All right, the closing process in 4 easy steps. Why do we have to close the temporary accounts? Because if we didn't, the balances would continue to grow and grow and grow. So the temporary accounts, the revenues, the expenses, and the dividends accounts all have to be closed at the end of each year so that when we look at the balance, it's always giving us a year-to-date amount and not a cumulative since the company was founded to date amount. So this way, when we look at how much did we have in fees earned, it's for this year because last year's balances ended up being closed. So in order to accomplish this, there are 4 steps. Step 1 is to close the revenues to income summary. Now, income summary is not an account that you're going to find in a financial statement anywhere. It is only used during the closing process. It is this account that exists for 3 entries, 3 of the closing entries, and then in the third one, the balance disappears. To close the revenue accounts, we would have a T account for each one of those revenue accounts, and their balance would all be on the credit side because credits increase the revenues. So let's assume we only have one revenue account and it's fees earned, and there's a $3,000 balance. To close that account means to make that fees earned account balance become 0. How will we do that? We're going to take the $3,000 and transfer it out of fees earned and into income summary. So if we record a debit to fees earned, it means that the balance is now 0, and the corresponding credit is a credit to the income summary account. So what are we doing? We are summarizing the revenues into the credit column of the income summary account. Step 2 is to close the expenses to income summary. So we look at each individual expense account. Now I've listed just a generic expenses with a debit balance of $1,200, but really you would have a separate T account for each individual expense. So selling expense, rent expense, salary expense, insurance expense. Every expense that the company has will have a debit balance in it, and each one of those is closed, and then one large debit gets recorded to income summary. So to close each one of them, you record a credit to the expense account and a debit to the income summary account. The balance then in each of the expenses is 0, and one large debit gets recorded to income summary for the summation of all of the expenses. Step 3 is to close the income summary account to retained earnings. And really what you're accomplishing here is what we show in the statement of retained earnings, where it's the beginning balance plus net income or minus net loss. How does that come about? It comes about through step 3 of the closing process, where the income summary account has now a balance that represents either the company's net income or net loss. If the credit side, the revenues, are greater than the expenses, we end up with a net credit balance, which is net income. If expenses were greater, then we would have a debit balance, and that would mean a net loss, because revenue minus expenses equals the net income. We then are going to transfer that balance from income summary into retained earnings. And notice now income summary has no balance remaining, and the $1,800 ends up being a credit to retained earnings. It's a minus plus, say an owner's equity account, so we are increasing the balance for the net earnings of the year. And then lastly, we want to close dividends to retained earnings. This also reflects what we show on the statement of retained earnings, where it is the beginning balance plus the net income minus dividends. Here's where we're going to be showing the decreasing effect that dividends have on retained earnings. Dividends have a debit balance. To close them, we record a credit. The corresponding closing entry debit is to retained earnings, thereby reducing retained earnings, and the dividends account ends with a 0 balance.